Hey everybody, welcome to another one of our summer editions of the weekly financial market roundup. This is for the week ending July 25th, 2014. What I've got on my screen here is a daily chart of the E-mini S&P 500 futures. You can see I got a lot of natural price levels sitting on here for support, these yellow dashed lines. I also have the RSI indicator, as you can see down here shown below. One of the things that I want to point out, and you can see it here, I've got a little upsloping trend line here that, we were able to honor right here with that little bit of this was an intraday dip. And then since then, there was only one closing day that we finished outside of this upsloping trend line. And then on Friday, of course, we were like sitting right on the line. So now the question is, going forward in time, what are we going to do? Well, some of the indications that I'm getting on my chart do seem to suggest that we've got to be careful here because the markets are going through a little bit of a topping action and we're getting weaker. You can see this indication right here on the RSI. I've got some bearish divergence, or as we like to say in our group, we call it a bearish divergence bed. And if we also look at the MACD, you're going to see the exact same thing set up here. We've got this bearish divergence here on this MACD that really started at the beginning of June, and now you can see right here, although it hadn't crossed below, and here's the zero line right in this area here, it looks like it's starting to roll over. Should it roll over, this would suggest that we're going to come down and test this natural support level at 1960. We've got a couple of other natural levels at 1952 and 1945 before we hit this upsloping 50 EMA right here. So I do not believe we're in for a very big push to the downside. I may be proven wrong, but I think in the near term we are showing some signs of weakness, and that's what we're going to see. Now, if we get further breakdown and we take out this key pivot low right there, then yes, we're going to go for a nice little run. The other thing that's showing me a little bit, or giving me a little bit of a cause for concern, is the Russell. Now, our members, I've been going over this quite often, and we've made some really good plays in the Russell and TNA, Tango November Apple, which is a 3x small cap bull. We've been playing that to the upside on these bounces. Now, we've got the rut has moved dramatically down in relation to the S&P. And we can look at the Russell futures. And you can see here, let's just step it out. You can see, and I spent a lot of time with our members, and I think I covered some of this in our weekly updates for our markets. You can see here how we had a transition in the rut, and we caught this support area here, and we bounced up very nicely. And at this run up right there, we had a really great play in TNA, Tango November Apple. It's that 3x ETF small cap bull. We had a really nice play here, and you can see we established higher highs and higher lows. This is from this down sloping trend line there of lower highs and lower lows. Well, now we had a very tight regression channel. You can see the width of this regression channel as we started rolling back over. We came down and we just placed perfectly on the 200 EMA right there at 1223 or 1123.80, and then we bounced up hard, and now we're back into this little bit of a rollover here. We couldn't really clear on an intraday basis the 200 EMA. The Russell is severely depressed for the year compared to the rest of the indices, and the Russell is a small cap, composed mostly of small cap stocks, and there's some mid cap, and there are a few large, but basically small cap, mid cap. And we want to see this up in this area up here, not down here. And remember, the rut is a little bit of a harbinger of things to come, a little bit of a leading indicator for some of the other markets. So what I'm looking at here is, going forward in time, is the rut in a position now in the Russell? Are we going to just kind of have a little bit of a test here and then shoot back up like this? Or are we going to fail the support area here, 1123, and then come back down and test this area down here? Right now, we do not know, but the markets and the indicators seem to suggest that's the direction we want to go. Now, this coming week, we've got a couple of key events happening with reports. We've got the FOMC, the Feds. Anytime the Feds belly up to the bar, folks, you know anything can happen. I do believe the Feds are going to continue in their tapering. We're down to 35 billion. Their goal, their stated objective anyway, in their FOMC meeting minutes, and what Yellen said in her quarterly press conference is that they want to have the monies completely off the table. No more stimulus by going into the November month. So October would be the last month. So right now, what we're resting on is a little bit of instability in the markets and our Q2 earnings that we're going through right now. So I just believe that, and with the rut, we had this double top right here, and then we just, we're giving it all back up. We may come back down and test this bottom down there. I would think, at least near term, that would be more of a intended direction. The other thing that's happening, if we look at volatility, and let me just get the daily chart of volatility up here. Here's the daily. You can see here with vol how we have been, and it's very insidious. It's very just each day, just a little bit each day. But you can see where vol, as measured by the VIX, was basically having a hard time right here. And now we've kind of like ended up right here with vol. And we've had this little bit of a chop where we come down and we test this multiple times, and then we just keep coming up to this area here. That would suggest to me that the markets are just very sensitive to noise, extraneous noise in the market. You can see this little slightly upward bias with the MACD as well, which would suggest that it suggests to me that vol is probably going to go higher. This would be the intended direction more than lower, which would suggest higher equity markets. So, we may get a little bit more volatility into the market leading up to the end of July, going into August. Now, of course, the Feds can really do a lot with that by their FOMC meetings coming up this next week. And we've also got some geopolitical risk that, you can't trade off of it, but you just have to understand the markets are setting themselves up for higher volatility and a little bit of a rollover in the markets. Because the other thing that I'm looking at here is bonds. Bonds had a very strong day on Friday. And you can see here with bonds, this point right here was an annual high in bonds. Okay, you can see that is right around June time, and you can see right around June before. This is where we were right there, right? Or right in this area here. So we're at an annual high right here, and it's not too much further to go to hit another price level at 139.27, a little bit higher here. So this is another area of cause concern because bonds have made this movement here. The other thing that I don't see in this movement with bonds, I would have liked to have seen it, but I don't. We've got this little bit of it looks like a cup and saucer pattern. We do not have bearish divergence. It's pretty flat here. Now, from this point here going way back, yes, we get a little bit like that. But when you go back that far, it negates some of the impact of a bearish divergence. This is going all the way back to the Q1 February time and when the markets kind of imploded to the downside. So this could suggest a little bit of a sell-off, and then boom, we're going to make one final run before we reverse what will be a longer-term trend of somewhere being down this area. Now, this is where I think bonds are going to end up some point down here. I don't know the timing of it. I think right now there's just a lot of geopolitical risk out there, and we've got this pattern that's shaping up, and we're at annual highs. So now the question is, are we going to break out and get more escape velocity and go higher? We're going to have a little bit of a natural pullback and then come back and challenge it again. I'm more in the camp of probably that pattern right there. And then if we challenge it and take off, then I could see us moving up here before we do a final rollover. Now, of course, we could get into this pattern right here, but rather than doing a retest again, we could just come right back down there, or we could just skip all the nonsense and blow right through in the early part of this coming week. excuse me, this coming week. So I'm watching this very closely. Most of you guys know I'm kind of permanently bearish bonds, but at these higher levels, it makes shorting bonds a little bit easier, um, because I believe that there's only one thing that's going to hold bonds up at this level up there, and that's going to be the equity markets are going to just give it up another 4 to 6%, and that'll drive bonds up here very quickly. If the equity markets give it up, then the bonds are going to be up here. Okay. And if that's the case, then I'm going to be getting ready to load up on some bond shorts because it's just naturally not going to stay up at this level. The way the Feds are kind of setting everything up now. This is what, but because we've got bonds at annual highs or near annual highs now, we got the Russell pulling back like it is in relation to the S&P 500. That does concern me a good bit. And just to show you guys just a little bit of what I call a ratio chart, comparing the Russell to the S&P 500. Let me just find it on here real quick here. Let's see here. Okay, here we go. Here is the Russell and the S&P 500. You can see right here. Now, just to show you what this chart really means or how to read it, I've got what's plotted on this graph is the Russell price divided by the S&P 500 price. And when this price is going down, that means risk is coming out of the market. And you can see since the beginning of July, risk is being sucked out of the market, and we've just taken out these lows here. This is a comparison chart, and there is no bullish divergence right here in this chart. That would suggest that the small caps are continuing to be punished while the money is seeking a little bit more safety in the large caps. But that's going to break down pretty soon as well if this keeps going in the direction that we're going. Not very good. And I do believe that the markets do seem to indicate that. If we look at the mid cap, this is MDY divided by the spiders. You can see the mid cap is also breaking down. And we do not normally see this when the markets are at near all-time highs. So money is coming out of mid-cap stocks. Money is coming out of small-cap stocks. Money's finding its way into large dividend-paying stocks and bonds. All of these are indications that the market just wants to give it up some. So right now, my portfolio, I'm about 35-40% long. But I'm very cautious long. I'm making some money on this, but I'm getting ready for some volatility increase here. And I think this week we got certainly a great opportunity with the FOMC and a few others. All right, everybody, I wanted to keep the update brief for this weekend. We're still in our summer months. The last 2 weeks of this month, I will be traveling in Europe doing a few seminars, so I will not be putting out our normal weekly updates, but then after Labor Day weekend, I will be back in full force. For our members, we have our session tonight, this Sunday night. So I will see you guys. We'll take a look at the economic reports coming up and some of the expectations of what we can do about it. All right, everybody, have a great weekend. Bye now.